Hey guys, welcome back to Click Capital, your go-to channel for market analysis, where I share all my insights built up over 20 years of trading and go through all the markets and charts today to let you know what's happened. Wow, today, biggest bank failure since 2008, Silicon Valley Bank, taken control of by regulators, going to get wound down. Second bank this week, by the way, after Silvergate on Wednesday, and that spread fears of contagion. And we've seen big moves in financials, even bigger moves in rates, which I'm going to get all into in this video. If you've been watching my channel and you knew yesterday I came in 100% net short. I've had an absolutely great day. I hope you have as well. Stay to the end. I'll let you know how I'm positioned going into next week. We've got CPI coming out on Tuesday, which is going to be a big one. But let's get right into it and go into the data. So let's dive in. And as always, we'll go look at the heat map today. So quite red out there, except for healthcare had a little bit of bump defensive. JP Morgan actually bounced, which I'll get into in a bit. But overall, mostly red out there, except for defensive, consumer defensive, and healthcare. Economic data. All right, so we had non-farm payrolls coming a lot better than expected. Still less than January, but compared to consensus, that's a tight labor market, which we would have seen rates hold up even more. But what's overwhelmed that today has been this Silicon Valley Bank situation, which I'll get into a bit. But we did have average hourly earnings come in a little bit worse than expected month over month and year over year. And there were some reports that a lot of these job gains came from the healthcare education sectors that were lacking in employment anyway. And we saw unemployment rate actually tick up to 3.6. If you remember yesterday, I said once this goes over 4, we're pretty much guaranteed in a recession. Once unemployment starts trending back up above its 20-month moving average, that's pretty much always signaled recession when we've got all the other indicators coming in place off a low number as well. Fear and greed ticked down big, ticked down 10 points. Yesterday we're at 34, today we're at 24. So there's a lot of worry out there. There's a lot of puts being bought today, which I'll get into in a bit as well. Another thing, a bit beside what's going on today, I thought I just wanted to share with you. It was interesting. Cathie Wood's flagship Ark fund tops $300 million in fees despite losses. So she's made, for her and her company, $300 million while wiping out almost $10 billion of investors' cash in the same period. It's unbelievable. And let me just quickly show you this chart to see how that's happened on Ark. So looking at a monthly chart, when we had this huge rise here, and she's on CNBC every other day, selling it, hyping it, she's on the next best thing. She's paying 50 times sales for all these amazing, wonderful stocks. She doesn't care about valuation. Then bam, crash. Look at that. So this is when, unfortunately, a lot of innocent new investors got in. Now, I know some of you might think, well, it's their own fault. Everyone makes their own decision. Yeah, sure. But you got to remember, a lot of these people are not experienced as you and I can see things the same way. They're getting pulled into the market from people like Cathie Wood, who's selling herself as, the ultimate guru and hero and into all these new innovative companies doing amazing things. But let's look at the results. Look at Ark versus NASDAQ. Since she's launched IPO in 2014, we changed this to percentage. It's down almost 38% versus the Qs. And this is how she's managed to lose $10 billion of investors' money. So when you've been buying Ark, you've been taking money out of your pocket and putting it into her pocket. Is basically what's been happening. So it's unbelievable. She still gets the attention and media celebrity that she is. She's great at marketing. She's not great at investing. She's no idea about valuations. She's great at coming up with these clever sounding, sound bites and presenting amazing stories, great storyteller, but she just burned through $10 billion of investors' cash. It's unbelievable. So I thought I'd just have to point that out today. But let's get into the charts. That's not the main story of today. The main story of today is what's happened with Silicon Valley Bank and operators taking control of that. So let me just give you a bit of an idea of what happened. So they've been around 40 years. They back a lot of the tech industry, VC industry out of San Francisco, and they took in a lot of deposits over the last, 20 and 21 as tech industry was booming. Cash was flowing everywhere. And so a lot of these tech startup companies, they parked a lot of that cash with SVB. Now, SVB took in so much cash, I think 120 billion or something like that, crazy, they couldn't farm it out in loans and credit cards and that, what banks typically do. They'll take your cash and give you 1%, sell it for 3, 4, 5%. So what they did is they took all those deposits and put it into long-term treasuries. In their infinite wisdom, they locked in rates at 1.4, 1.5% on their deposits. So we've had a huge move up in rates. The value of all their treasuries and securities plummeted. And then, tech companies also facing higher rates, burning through cash a lot more. So they're taking out their deposits out of the bank. Their deposits are well less than what they have available on immediate liquidity in the long-term treasuries. So they have to sell the treasuries securities at a loss, raise capital, spooks investors big time, fund managers, advisors telling them to get out. Classic story as old as the hills, bank run. Happens so quickly. Look at this, last month we were trading up at 340. This morning it was pre-market at $39 and it's been halted. It's done. It's wound up. The Feds have taken over. Going to try and give everyone their deposits back next week. 40 years bank, done, poof, gone, 2 days. So the regulators probably wanted to stop contagion by stepping in and doing this. And I know there's been a lot of talk in media today, contagion this, but overall the banking sector is a lot more safer and well capitalized and less leveraged than back in 2008. Since then, the government's done a great job at cleaning it up, making it a lot safer. So this is probably what they did to prevent contagion. And it's only the 16th largest bank in America, so not a big one. And so I think the fears of contagion are a bit overblown. We did see JP Morgan actually end up today. It's probably the biggest stock that ended up the most, actually. So I think it's a bit overblown, but still, this could keep going. This could spread into something else. So it reminds me of kind of in, I think it was June or July in 2007, Bear Stearns closed down 2 of its hedge funds, that were trading in mortgages or whatever. And that was kind of when things were kind of okay. It was still on the, the later end of the bull market. And it kind of caught everyone a little bit by surprise. It's like, wow, they had to close down 2 hedge funds. They lost 90%. It's like this one's kind of come out of nowhere. It's like, the financials are kind of tracking along all right. If we just look at the financial ETF, where is it? It is here. We were tracking along okay, kind of about to look like we're breaking out. And it's kind of just spilled over. And regionals as well. Look at this move on regionals. We're 16% below the 50 bar. Candle completely below the buy-sell band. This thing is super oversold right here. I actually took a long in a regional today, which I'll show you in a bit later. For a bounce and for a little bit of a hedge on my shorts if we do get a bounce next week, which I think we might. So obviously there is a lot of fear in the air and with these banks, smaller banks, but I think we'll hear something from the Fed or maybe even higher up over the weekend into Monday. Especially if pre-market Monday is really weak, if there's a lot of fear, I think they'll step in with something and try and prevent contagion from everyone, trying to do a bank run on the entire sector, basically. But let's get into SPX. We closed at 38.61, only off 1.4%. For all that fear out there with the VIX rocketing and what's going on, wasn't down that much because it got mega cap tech holding up a bit. And that's why I've added today the equal weight S&P to the list here, which was down 2.1%. So all 500 stocks are weighted equally. We can see what's going on broader in the market. So the breadth fell off a bit more today than the big indices. Q's only down 1.4%. Smalls got hit hard, as you can imagine, as they've got all the regionals are in the Russell index. So that came off pretty hard, almost 3% today. We did get a little bit of a bounce there in the end, but not too much. Internationals off as you'd expect. Canada under its 50 bar, same with the FTSE. DAX just kind of sitting at it. Nikkei still above, but came off really hard in Friday's session. So did Australia, and China just sitting down there a little bit. Volatility. Look at this move we had today. A lot of volatility out the markets. That's what I mean by the SPX only down 1.4%. But look, we got VIX 9 days shot up to 32 today. VIX shot up to 28, 29, but came off hard. That volatility was sold down into the afternoon session. And in terms of the structure, we've got a little bit of backwardation at the front to 30-day, but then it goes back to contango 3 months, 6 months. So it's kind of the market saying it expects volatility to be higher going 3-6 months out now, like something's changed, but it expects it to come down over the next month. So it's kind of a little bit of a U shape there, but kind of reasonably flat as well. We had volatility jump huge today. This thing spiked big time, up to 126. So there is movement out there. And the VIX premium over realized jumped to 9% too. And MOVE, the index of bond market volatility, has spiked up as well and moving up higher. So things are moving. And look at the put call ratio, up 20% to 1.25. Equity put call ratio 1.46. A lot of people buying puts out there today. The fear is definitely alive and well. Over to breadth. Amount of stocks above their 20-day average, very low here, down at 6%, typically where we see a little short-term bounce. And then now we've got 41% of stocks above their 200 bar. So one could argue when this thing goes under 50, there's an active bear market. You got less than stocks above their long-term trend. So that's what we have right now. And the amount of stocks making new highs is low too. So structurally looks like bear market still well and alive. Gross cyclicals came off a bit today, and that has come off pretty hard today, price action wise. Same with high beta versus low volatility, down 2%. So definitely a bit of rotation into safer stocks there today. And smalls, after starting off the year really well, they're just completely fallen out of bed here, big time. Yield curve jumped today, and high yield versus treasuries now sold off really hard. Risk coming out of the market. Look at this in rates. Wow. Oh my. Down 2-year at 4.59. This was just, you've been watching the channel, how much strong price action. Things just totally changed today. Even though with the stronger than expected jobs market, what's happened is, what's going on now is because of this contagion or fear of contagion, there's at least fear of contagion. The rates market is saying, well, Jay's less likely to do 50 basis points. Now we're back to 25 basis points as the favored one. It's all changed basically overnight with what's going on out there. Not only that, but what's more created this move is the flight to safety. Because people are scared with their deposits. They want to get them into treasuries, and you can get a treasury bond 4 or 5%, and get against what's happening in stocks. So there's been a huge flight to safety. Had the 10-year come off 3.7. June Fed funds, September 5.23. This is huge moves. Even though we're down back to the 50 bar, this is a huge quick pullback that we're seeing, all that volatility in the bond market. And same with overseas. UK government bonds and euro, even Japanese has had a pop down as well, the Japanese 10-year bond. And we can see that in the treasuries. Look at that today, 20-year Treasury TLT, up 3.45%. That's a huge move for treasuries on 43 million shares. So that's that flight to safety I was talking about, into longer dated, safer treasuries. But with that huge drop in rates, what did high yield do? Nope, sorry, new lows today. That's the, again, flight to safety and out of risk, even though we've had bonds should be worth a lot more today with rates coming off that high yield. High yield is a no thanks from big investors. And with rates coming off, as you'd expect, the dollar have come off, and we actually got down to 103 there today, and is definitely pulling back. Bitcoin coming off, got down to 19,500 as you'd expect. Commodities, commodity complex held, bounced off the support level that we've been watching. The winner today was gold, and I'm now long gold as well. With this big change, I think it is becoming a bit of a safe haven, and with rates and the dollar coming off, and this price action in gold today was so strong, I've jumped on that as well as a little bit of a hedge. Over to stock sectors, the only sector we saw up today was gold miners. Everything else was red. Ark down 3.4%. Yeah, but don't worry, Kathy still makes $250,000 a day in fees, so she's fine. Clean energy down 3.3, discretionary down 1, semis down 1.6. Biotech came off really hard, 3.9% off biotech. Regionals, down today, but big spinner on big volume. So I think we could get a bounce here tomorrow. And that's kind of why I added a regional as a hedge to my shorts, because we do get a bounce. The high betas will bounce as well. But if this falls apart completely on Monday, in a Black Monday or something like that, then my shorts will do even better as well. Real estate came off pretty hard, 3.1, and home builders, I've been bearish on that for a while, off 2.2. Defense stocks off 1%, but still weak. There's a lot of volume coming out in all these. Look at even industrials, 1.8. Look at this volume. There's a lot of selling today. Health sector down 0.7 volume. Staples held up a bit better, and utilities off 1.5. BlackRock off 2.5. JP Morgan, look at this price action. Let's go down to a 15-minute chart. Gap down, held, and bought. Didn't even come down to retest it. So that was interesting. That's what tells me I think everything should be okay. Because if things get bad, we'll see the Fed come into action, the next minute. They will come out, they will shore it up, they'll prevent, contagion, and a sector bank run and all that. So I'd rather have that on my side than against it. And I think the move, the shorts down in banks now, it's been had. So now I'll be looking for, possibly we get a bounce next week. And JP Morgan price actions telling me that could be the case. Mega cap tech, again, what's holding up the indices? They're not off much, just 1% and a bit for all of them. Nvidia down 2. Tesla actually had a little bounce, little spinning hammer there, and just held. Meme stocks got creamed as you'd expect, except for Bed Bath Beyond. AI looks to be falling over. And look at some of these moves in the other regionals today. Pac West, ouch, down 38%. That is nasty stuff. Signature Bank, down 22%. They've got crypto-related industry as well, so I wouldn't go near that. SVB, sayonara, see you later. I'll see you never, actually. It's dead. And other big moves today. Bill, down 15%. DocuSign, down 22%. Charles Schwab was surprising to see it down 12%. So they've got more into deposits than that. But you'd think of them more as an investment and broker in that. So I think that's probably a decent buy there. Short-term bounce and a long-term. Actually see it up a little bit in after hours. Oracle was off a little bit too after their earnings. And this is one I took a bit of a sneaky long in today. Bank OZK. So this thing was way oversold today. Technically, I saw it hold on as well. And if you look here in our distance to mean, 16% below the 50 bar. Yesterday, it was 13, which was another record. But normally the extremes are at 10%. So 16%, we're 60% lower than previous extremes below. The whole candle below our bottom buy sell band, which is huge. And I checked over the financials. This thing is a lot safer even than JP Morgan. It's its cover ratios, its debt to assets, deposits, credit ratings, and all that. So it's this its numbers appeared to be a lot safer, and I'm looking for a 50% bounce up from when it was last at its 50 bar VWAP to this crazy low today. So I'm looking up for high 39s just before it hits the 40 psychological level on that. Of course, I've got to stop and won't hold this thing if it spirals further, and we could spill over on Monday even further, the whole sector. But if that happens, I can imagine my high beta shorts will continue to slide as well. So I just took that as a bit of a contrarian play and looking for a bit of a technical bounce, because if it gets bad enough, I think the Fed will come out. They won't just let everything turn to hell. They'll come out and backstop it somehow, some way. Okay, so now we've looked at everything. Let's recap and talk about where we are going forward. So I've been bearish ever since up here when I got net short again, and it's done pretty well going into this. We are coming down into the low of our range here. So if you look at the equal weight S&P, the Qs are still kind of we had this huge range expansion. So they're not oversold, but smalls are as well. So, I mean, this thing either keeps diving on Monday and we completely fall apart, because that's kind of like a crash pattern there, especially with volatility, or we get a bounce. And so we don't have that huge backwardation and volatility anymore. But, I mean, there's a lot going on out there. There's just a lot to look at. Tricky as always. With rates, what happened in rates today was crazy. Jobs coming in tighter, the flight to safety in bonds, bond volatility, huge volume, fears of contagion. I mean, it's hard to say. This could, it wouldn't surprise me fall apart on Monday and that damn wall breaks. Or I'm thinking we most likely hold and get a little bounce, because they'll come out and backstop it. If we open up, futures open up Sunday night really weak, you watch, they'll be getting together in their meeting room Sunday night, and first thing Monday morning, like 7 a.m, they'll come out with something to backstop it, and that'll send futures ripping higher probably. But dynamic, fluid situation as always. Anything can happen. I came in today 100% net short, did really well, but with getting long gold and that regional, I finished the day, and I took a profit on a high beta short too that fell apart. I finished the day 40% net short. So I don't want to be long here and try and catch a falling knife. No way. But I don't even want to be neutral as well. I just want to be a little bit short. And like I said, if we do get a bounce, I should get a good bounce out of that regional. But if it does fall apart, then my high beta shorts should fall apart as well. So I'm 40% net short going into the weekend. We've got CPI coming out on Tuesday. That is going to be a big one, because, I mean, if we get a bounce and everything goes back to kind of fine and it's okay, that's contained, it was just Silicon Valley Bank and tech, they kind of stuffed up with their deposits and investments and all that, maybe the 50 basis point comes back onto the cards. Maybe, especially if CPI comes in way hotter than expected. It's expected to be 6.2% year over year. So if that was 6.4, 6.5, then the case for 50 basis point could be made. But as it stands, markets can change really quickly, and you've got to change with them. And with that change in rates now is huge. So as it stands, now we're going back to 25 basis points on March 22, Wednesday next, from the Fed. And the bigger theme from the repricing of rates is the flight to safety. That was the big theme today. Investors going into treasuries and getting out of the risky stuff. So I think we see a bounce in regionals next week. And for the rest of the market, we'll have to just play it by ear and see what happens. But for now, 40% net short, and we'll see what happens over the weekend and come Monday morning. Should be interesting. All right, guys, that's it for me today, this week. Also, just wanted to, before I go, just really thank all you guys. I know a lot of you guys watch me every day and comment. I really appreciate that. I've got over 500 subscribers now. The channel just hit 2 months old today, and I didn't think I'd hit 500 subscribers this quick. So I hope you find some value in the way I look at markets and dissect it and present it, and just really appreciate all your support that you give to me and the channel, and it really helps me to keep going. So I hope to see you guys stick around for longer, and we can help each other, because I listen to everything you say as well in the comment section, and I think it's great to have that community where we can kind of just bounce ideas off each other and see what we're all thinking. And a lot of the time I learn things from others that you didn't think of in a certain way, so it's just good to hear other people's opinions on it. So please let me know in the comments what you think after today. We had a really interesting day, and tell me how you read it and what you see. Maybe I missed something, maybe you might see something a bit differently from me. So please let me know in the comments what you think about today and what you think that means going forward, short term and long term. All right, guys, have a great weekend, and we'll see you again Monday afternoon.